Imagine this. You and a group of like-minded friends or family members pool your resources to unlock the dream of owning not just one, but multiple properties. It's an opportunity to build wealth together, leverage collective buying power, and create a diversified property portfolio that none of you could have achieved alone. But here's the twist. What happens when it's time to sell? Let's dive into the financial realities and clear the air about how the net proceeds are shared, so you can step into this venture with clarity and confidence. Let's dive into the financial aspects of this method of owning properties. In this example, you are purchasing a property for $1 million.
Hi, my name is John. I will come up with $160,000, being $150,000 for the deposit and $10,000 to share upfront legal, renovations, agent commission costs.
I am Michelle. I will come up with $160,000 for an equal share of 50%.
There are several key aspects to this transaction. First, we have the company, which acts as both the property owner and the loan holder.
I am the company's shareholder and director.
The company owes the bank $700,000 for the property.
The company owes both Michelle and me $320,000.
Question: if the property was sold at $1,100,000 with additional legal and other fees of $20,000, what would be shared amongst you?
$540,000, of course.
No, I believe there is more to it. We have to pay the bank $700,000 and lawyers $20,000, which leaves us with $380,000. We will then split this 50% and get back $190,000 each. Am I right?
Unfortunately, you are both wrong. Although numerically, assuming there is no tax involved, you may be right that each will receive $190,000. However, the law distinguishes between investors and the company, the real owner of the property. The company, not John and Michelle, earned a profit of $60,000 from the sale of the property.
I am the shareholder of the company, so the company will distribute the profit to me as dividends.
Michelle would then pass on $30,000 to me as share of the profit.
Let's take a closer look at the cash flow from this property sale. The property was sold for $1,100,000. First, the outstanding loan of $700,000 was fully repaid to the bank. Next, $20,000 was allocated to cover legal fees and related transaction costs. Following that, John received $160,000, and Michelle also received $160,000 as reimbursements for their contributions. This left a remaining balance of $60,000, which was distributed as dividends to Michelle. As part of their arrangement, Michelle then gave $30,000 to John as his share of this agreement. This ensures that all financial obligations were settled and the arrangement between the parties was honored.
Seems straightforward enough. No need for complications.
As long as we account for the transactions and return the funds the right way, all should be good.
Let's take a closer look at the financials of this rental property. The property generates a rental income of $48,000 per year. From this, $6,000 is spent annually on rental-related costs, such as maintenance and management. Additionally, $28,000 goes toward interest expenses, calculated at an assumed rate of 4%. After these deductions, the net rental income comes to $14,000 per year. However, corporate tax applies, and $2,380 is paid in taxes on this amount. Finally, after accounting for all costs and taxes, the net rental income available is $11,620 per year. How was this accounted for on a year-to-year basis amongst the investors? Let's look at this from the cash perspective. The property generates a rental income of $48,000 per year. From this, $6,000 is spent annually on rental-related costs, such as maintenance and management. Additionally, the annual mortgage payment amounts to $42,000. After covering these expenses, the property incurs a corporate tax of $2,380. The result is a negative cash flow of $2,380 per year. This cash flow calculation focuses purely on the actual inflows and outflows of money, capturing the immediate financial reality of the rental property. It accounts for rental income, operational costs, mortgage payments, and corporate tax, ultimately revealing a negative cash flow of $2,380 per year. However, a financial calculation would take a different perspective, ignoring principal mortgage payments, but only includes the mortgage interest, hence resulting in tax payables.
But I understand that the rental income would have covered the mortgage payments. So, there should not be any effects.
The company paid property tax, corporate tax, repairs, commissions, besides the mortgage payments over the years. So I am not too sure.
What was the financial arrangement between the parties? Let's break down how the final cash flow sharing should be structured to ensure fairness and transparency. First, we start with the net sale proceeds from the property. This is the amount remaining after deducting the outstanding mortgage and all associated sale fees. Next, we account for the rental income and rental expenses during ownership. If there were annual cash flow deficits where rental expenses, including mortgage payments, exceeded rental income, these accumulated losses are deducted. Conversely, if there were annual cash flow surpluses where rental income exceeded expenses, these are added back. After that, we deduct the reimbursement of initial outlays, ensuring that all contributors are repaid for their initial investments, such as the down payment or other significant upfront costs. What's left is the total net balance. This balance represents the remaining cash available after adjusting for operational cash flows and reimbursing initial contributions. Finally, the net balance is distributed among the parties according to the agreed sharing arrangement, reflecting both the financial realities of property ownership and the terms of the partnership. This structured approach ensures that rental income, expenses, and contributions are fairly accounted for, leading to an equitable distribution for all involved. So, do you know what to do next?
I will prepare the accumulated statement and share it with John.
I did not know that it would be so complicated. We should have done this on a yearly basis.
Yes, always speak to a domain expert on these matters. Not all accountants are familiar with this sort of arrangements.
Okay, let's do this, Michelle. Please prepare the yearly or accumulated statement so that we can look and agree with the numbers.
Hold on, you can do the following first too. You need not wait for the full and complete statement of accounts.
We don't?
Oh yes, I get it. The company can return the initial outlay to the investors first, since the property has been sold.
Not so fast.
Yes, I know. If the net proceeds exceeds the capital outlay, it would mean that we can return the initial capital to the investors.
We will then wait for the statements to be prepared to derive the final net balance as discussed previously.
Awesome! You guys are doing well. Thank you for watching this video. Owning properties can be an exciting journey, especially when you partner with trusted friends who share your vision and can collaborate effectively. Always make sure to include your trusted accountant and tax advisor in the process. Their guidance will streamline every step, from purchasing the property to managing it and eventually selling it. If you found this video helpful, please like and subscribe to our channel for more insights. Thank you.